Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. Today we're going to be looking at retained earnings. As we do in each one of these fundamental analysis tutorial videos, I'll give you the actual definition, and then we'll go on to look at some examples and give you a little more insight. Retained earnings refers to the portion of a company's net income which is retained by the corporation rather than being distributed to its owners or stockholders as dividends. If the corporation takes a loss, then that loss is retained and called retained losses or accumulated losses. Retained earnings and losses are cumulative from year to year, with losses offsetting earnings. For this example, we'll be looking at the Walmart Stores Incorporated balance sheet, and you can see this is the annual data. You can scroll on down to the third section on the balance sheet under the stockholders' equity to find retained earnings. Let me get out the tools right quick. Here's the stockholders' equity, and then that's broken down into the little pieces. We've already gone over each one of these items in video format. Now we're covering retained earnings here, and you'll notice that you have a big chunk right here of 68.6, and this is common in most stocks, especially those that have been around for a long time. If they're profitable for a long period of time, then they're going to have a very large number. It's probably the largest number you're going to find under the stockholders' equity section. Probably the most important item to note here, because a lot of people make this mistake, is they look at this and they think that retained earnings is just a big pile of cash that the company is holding. That's not accurate. Retained earnings has to be used to do one of two things. Either the company is going to invest into its future by purchasing assets or expanding in the company by research and development, something of that nature, or they can pay off their debt. That's another thing that they can do with it. And those are the two things that they can do with it, and it's really important that investors analyze what the company's management is doing with this retained earnings, because you want to see that being smart use of your money, because basically that is your money. Whenever you own shares in the company, they have earnings. That earnings is either paid out to you in the form of a dividend or it's retained. In most cases, there's a little bit of a mix. Companies are going to pay out a portion in the form of a dividend, and then they're going to reinvest into the company and try to grow the company. If it's done properly, then the company grows over time, and it's great for you. If it's done poorly, they're just mismanaging your money, and over time you can see this number here. In this case, it's a positive number, but you could see a negative number here. So if you had a company showing loss after loss after loss, it would just pile up as a very large retain. Instead of being earnings, it would be accumulated loss. In the particular case we're looking at here with Walmart Stores Incorporated, you can see that they had 63 here, and then again 68 here. So they've been growing that retained earnings from one year to the next, and that's good. It means a couple of different things. It could be telling you you ought to, of course, follow the company to find out what's going on and read the annual reports. But for example, a company could do no better from one year to the next on their earnings potential. So let's say they made $1 in 2010 on their earnings, and they made $1 in 2011. So there's no change in how much they made, but they decided they weren't going to pay out as much in the form of dividend. If they were to cut their dividend or slash their dividend, then you'd see retained earnings increase. That's one way that you might see it. Another way would be that the company actually invested their retained earnings very well, and they of course grow the company, and then they produced a greater earnings per share. And if they continue to maintain the same dividend level, still paying out the same rate, then you would see retained earnings increasing, because a larger portion would be retained. So there's different things that can happen, and the company management can do, and those changes that management would choose to do will alter retained earnings. So it's important that you keep up with what's going on here. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.